Hi everyone, welcome back to 8th video of consolidation chapter. Today we are going to see this another adjustment of consolidation that is called revaluation of assets and liabilities of subsidiary company. But now before discussing the technicalities of this adjustment, like what differently we have to do and everything, first let's understand the background of this adjustment. How did this adjustment came into the picture? Why do we need to do revaluation? So to understand all of this, let's take a simple example. Let's say there were two companies, Alpha company and Beta company. Now what happened was Alpha company said to the Beta company, see Beta company, I want to acquire a controlling stake of your company and make you my subsidiary. Beta company replied, okay fine, I will be your subsidiary, but first you have to pay me purchase consideration to get that controlling stake. Okay, so Alpha company said, yes, of course, I will pay you the purchase consideration. Tell me how much is it? We will negotiate. So Beta company replied, first, let's just do the valuation of the shares of my company. I will do the valuation of the shares of my company and I will then quote you the purchase consideration. Okay, so Beta company now have to value its shares. So now think, how are they going to value its shares? Now you all know there are many factors to consider and many methods available to do the valuation of shares. But just to keep things simple, let's just say Beta company chose net asset method of valuation of shares. So what happens in that method? You remember? In that method of valuation of shares, we take market value of the assets minus market value of the liabilities. We get net assets, divide the net asset by total number of shares, we get value per share. And that's what Beta company did. Okay, and based upon that value per share, they quoted the purchase consideration to Alpha company. Alpha company paid the purchase consideration after negotiation and everything and made the Beta company its subsidiary. Is that clear? So now one point I wanted to make to you here was that PC is based on market value, isn't it? Because PC was calculated based upon what? Value per share, and value per share was calculated based on what? Market value of assets and market value of liabilities. And that's what will always happen, you know, always market values will be considered. Why is that? Because just take your example only. If you have some valuable asset, with you, then what you will do? Will you sell it at whatever the value you think it can be sold at? No. What you will do? You will find the market value of that, at what price it can be sold in the market, and at that value you will try to sell it, isn't it? Yes, that's what everyone does. Everyone trades at market values only. So that's what this Beta company also did. Market value of assets minus market value of liabilities. In all the methods also, what happens? Market value is given importance. Okay, so PC purchase consideration is based on market value. Now understand what Alpha company will record in its separate financial statement. On the asset side of the balance sheet, they will record we have made investment in Beta company and they will take market value of that, isn't it? Now they have paid that purchase consideration to acquire what? To acquire what? To acquire the net assets of Beta company, isn't it? So now just think for a minute. They have paid something, some amount, purchase consideration to acquire something. So this is net assets and this is the PC, right? So this PC is at market value and this net asset also should be at market value, isn't it? Now here what will happen in subsidiaries company's financial statement, in their separate financial statement, there will be assets and liabilities, but they will be at the book values. In the financial statement, book values, right? For example, a building is there, let's just say for example, of 80 lakhs. So most probably it will be carried at cost. Okay, that's what most of the companies do. Everyone carries the assets at cost model, cost less depreciation. So building is at 80 lakhs. Now just for example, let's just say the market value of that is 100 lakhs, 1 crore. So now what's happening? The Alpha company has paid something, something market value for that, acquiring that building, and here you're comparing book value with that. Here you are comparing book value with that. Just for example, if you are doing that, then it would be completely unfair. It would be completely unfair. How can you compare market value with the book value and you can say, oh, we have gained by this purchase, we have lost by this purchase? You can't. What you need market value versus market value. Then only it would be fair. That's why what happens? That's why holding company will revalue the assets and liabilities of subsidiary company on the date of acquisition. This is the money we have paid. What have we got? We have got net assets, and bring me the market value of those net assets. Then only we can have fair comparison and we can calculate correct goodwill or capital reserve. Is that clear? Understand properly. See, on the date of acquisition in working notes, what do? What does the holding company do? Holding company does a comparison on the date of acquisition with, cost of investment to net assets of subsidiary that is owned by the parent. These two things are compared. And now PC, cost of investment, purchase consideration, is at market value. Yeah, just now I told you it's at market value. So net asset of subsidiary that is owned by the parent, that whatever they have acquired, that also should be at market value, both at market value. If this is at book value and this is at market value, then what will happen? The comparison will be totally messed up, and the resultant differential of that is goodwill or capital reserve, will also be messed up. Yeah, you need proper fair comparison. That's why what the holding company does, holding company revalue the assets and liabilities to their fair value. Whose assets and liabilities? Subsidiary companies' assets and liabilities. Is that clear? This is the logic why revaluation is done. Okay, is that clear to you? And there's one more point, see, in consolidated financial statement, what will happen? The purchase consideration is there, the differential amount is goodwill or capital reserve, that's fine. Now the assets and liabilities, they should also come at the what? At the market values in consolidated financial statement. Then only it will match. Okay, that's why what the holding company do? Revaluation. Okay, so that was the background of revaluation. Now let's discuss specifics and technical things of this adjustment. Now let me state some hard facts about revaluation adjustment that you always need to keep in mind. The first thing is, when will revaluation happen? Revaluation will happen on the date of acquisition. Who will do this? Holding company will do this. Whose assets and liabilities are being revalued? Only subsidiary companies' assets and liabilities are being revalued. So the next question is, if the revaluation is done on the assets and liabilities of subsidiary company, then is it going to affect the separate financial statement of subsidiary company? No, it will not. It will not affect separate financial statement of subsidiary company. The assets and liabilities will still be carried at the book value only under the cost model less depreciation. Okay, they will not change in the separate financial statement because this revaluation is done only for the purpose of consolidation. So it will only affect consolidated financial statement and not separate financial statement. And holding company's assets and liabilities over here in this adjustment are irrelevant. Is that okay? So these are some hard facts that you always need to keep in your mind. It will happen on the date of acquisition. Holding company will do this. Assets and liabilities are being revalued of subsidiary company. It will not affect separate financial statement. Okay, they will carry the assets and liabilities at the book value only. It will only affect consolidated financial statement. Is that clear? Right. Now, there can be two scenarios over here, right? Revaluation means what? Revaluation upwards or downwards. You all know that. For example, let's say the book value of this building is 80 lakhs in the subsidiaries company's financial statement. So the scenario one is, let's say the market value is 100 lakhs. So there has been revaluation upward, increase of 20 lakhs, right? So that's called revaluation gain. You all know that. Now, because of this revaluation gain, what will happen? There's one more thing that happens because of revaluation gain, that is called additional depreciation. Previously, subsidiary company used to charge the depreciation on 80 lakhs. Let's just say it's 10%. So how much is that? 8 lakhs. Yeah, just for an example. And now what happened? Market value has become 100 lakhs in consolidated financial statement. So now the depreciation has to be charged on this market value 100 lakhs. So that is 10 lakhs, isn't it? So there has been additional depreciation of how much? Of 2 lakhs. Previously they used to charge 8, now they have to charge 10. So 2 is additional depreciation, isn't it? So additional depreciation will be there. So what is the effect on profits because of additional depreciation? Negative effects. Yeah, because depreciation is an expense, right? So your profits will decrease, isn't it? Yeah, it's simple logic. We all know that. And the scenario 2 is revaluation downwards. Yeah, the market value is 70 lakhs, the book value is 80 lakhs. So 10 lakh decrease is there. Yeah, so that would be called as a revaluation loss. You all know that. And now if we have revaluation loss, then it is opposite, savings in depreciation. Previously, subsidiary company used to charge how much in their financial statement? How much? They used to charge 8 lakh, but now the value has gone downwards, 70 lakhs. So in consolidated financial statement, how much depreciation needs to be charged? How much? Depreciation should be only of 7 lakhs. We are talking about 10% depreciation, right? So 7 lakhs. So 1 lakh saving in depreciation is there, isn't it? 8 minus 7, right? 10%, 10%, right? So saving in depreciation is of 1 lakh. So this will have a positive effect on profits, isn't it? Yes. So do you understand? These are the two scenarios that we can have in this adjustment. Okay, revaluation gain or revaluation loss, additional depreciation or savings and depreciation. Now, understand properly, how does the revaluation affect our working notes and everything? Revaluation affects our cost of control, isn't it? How does this affect cost of control? Because in cost of control, we compare the PC with the net assets of sub that is owned by the parent. Yeah. So we need market value of the net assets of subsidiary that is owned by the parent. Yeah. And here in the books, we will have the book value, which is not enough for us. We need market value. So we have to make some adjustment to this, yeah, add or minus, then only we will have net assets of sub that is owned by the parent. But now understand, in the questions, we don't have the details of assets and liabilities on the date of acquisition. Do we? No, we don't have that. Yeah, what do we have always? We only have what? We only have equity, yeah, on the date of acquisition. You all know net assets can be calculated by two ways: asset minus liabilities net assets, yeah, or through equity approach. Just pick out equity. Now here what's happening, the market value of assets and liabilities are considered and you will get net assets. But this thing you cannot do. This detail will not be there in the question. So what you have to do, all these affect revaluation gain, revaluation loss, savings and depreciation, additional and depreciation, whatever that is there in the question, these effects you have to give in this equity approach. And we will do this in analysis of profits, analysis of net assets in the working note number 1, AOP. Yeah, there we will give the effect of this. Yeah. So what you have to do, understand properly, it's very simple. Revaluation gain is what? Increase in profits. Revaluation loss is decrease in profits in reserves. Yeah, revaluation surplus or revaluation, yeah, loss, right? So you have to give the effect of this in pre-acquisition profits. Because in analysis of profits, what do we have? Post-acquisition profit and pre-acquisition profits. And the effect of this we have to give in pre-acquisition profits. Okay. Now, why in pre-acquisition profits? Why is that? It's very simple. Understand very carefully. Because see, the market value has been accrued. This market value has been accrued on the date of acquisition. Yeah, before the date of acquisition. We acquired on a certain date and market value on that date is 100 lakhs. So that increase of 20 lakh has happened previous to this date, So all that has been accrued in the pre-acquisition period. So the effect of revaluation gain and revaluation loss should be given when? It should be given in the pre-acquisition profits. Okay, because it happened in the pre-acquisition period, so pre-acquisition profits. All right. But additional depreciation and savings in depreciation, these things happen after we have done the revaluation, after the date of acquisition, so post-acquisition. The effect of additional depreciation and savings in depreciation, we will give this in profit and loss in AOP in post-acquisition. Okay, after the date of acquisition. The logic is very simple. These things accrued previous to the date of acquisition. We calculated the market value, we got the market value on the date of acquisition, but the accrual happened previously. Yes, so these will be, adjusted in pre-acquisition profits and these will be adjusted in post-acquisition profits, profit and loss. Okay, so this is what we have to do. Now let's get to the specifics actually now. Yeah, the steps that we have to follow in this adjustment. You have got a perfect background and also a proper overview over here and the technical details on date of acquisition. Holding company will do this. Assets and liabilities of subsidiary company, no effect in separate financial statement, only in consolidated financial statement, and holding company's assets and liabilities in this adjustment is irrelevant. Is that clear? Now let's go to the steps that we have to follow in this adjustment. Now let's understand what differently we have to do in the problem when we have got this revaluation adjustment. See, it's very simple. What are we doing over here? We are revaluing the assets and liabilities and giving that effect in consolidated financial statement. So when is this revaluation happening? It is happening on the date of acquisition. You all know that. And to do the revaluation, we need two values, market value and book value. Compare that and see whether we have revaluation gain or loss. So those values, market values and book values, should be of the date of acquisition. Okay, but now what happens in the question is, in the question, market value on the date of acquisition will be given to you, but not the book value on date of acquisition. Book value of closing date will be given to you, but not the date of acquisition. So what do we need to do? Of course, we need to calculate that, and it's very simple to calculate. Let me show you how we are going to calculate book value on date of acquisition. See here, let's take a simple example. Let's say one company acquired another company on 1st July. So 3 months is the pre-acquisition period and 9 months is the post-acquisition period, isn't it? Yes. So if there is a revaluation adjustment in this example, then we need market value and book value on 1st July. Okay, and this is the date when revaluation happened. So we need the market value and book values on that date. Is that clear? Yes. But here in this example, we have the value of the asset, book value of the asset on the closing date as 72,000. And let's say, for example, market value is also given over here as 1 lakh. Okay, on date of acquisition. But book value is on closing date, not on date of acquisition. So what do we need to do? We need to bring this value on date of acquisition. It's very simple. How can we do this? See, this closing date value of the asset is after charging depreciation, and let's say the depreciation charge is 10%. So this 72,000 is at 90%. Do you agree? See, understand, whatever the opening value was, we don't know right now. After charging 10% depreciation, then it became 72,000 in the subsidiary's financial statement, in subsidiary's balance sheet, and that's the value we have. This 72,000 is at 90%. So what do we need to do? We just need to divide this 72,000 divided by 90. Once you do that, you have got 1%. What is the 1% value of that asset? So if you multiply this by 10, because 10 is the depreciation rate, 10%. So if you multiply by 10, what will happen? You will get the depreciation of the whole year. You have got the depreciation of the whole year. 72,000 divided by 90, you have got 1%. 1% into 10%, I mean 10, not 10%, 10. You have got the depreciation charge of the whole year, but you need depreciation only of this post period. Okay, so into 9 divided by 12, that is equal to 6,000. What did I do? I calculated the depreciation charge of this post period, of this 9 months period. So if I just add that depreciation charge, if I just reverse that 9 months depreciation charge to this value, I will get the value on date of acquisition on 1st July. See here, 6,000, 9 months depreciation, plus 72,000, the closing value. I have got 78,000 as the value, book value on the date of acquisition. This is what you have to do. You just have to reverse depreciation charge of post period to calculate the asset value on date of acquisition. You can also do it other way. See, there is one more way. What you can do is 72,000, just gross it up entirely. 72,000 divide by 90 into 100. So you have got 80,000. This is the opening value. Completely I have taken it back, and then charge the depreciation, 3 month depreciation. You have got book value on date of acquisition. That way also you can do. Okay, but this is more easier way. Just calculate 9 months depreciation and add it to this value. You have got date of acquisition value. Is that clear? Both the options you have. Fine. So this is how you will calculate. Is that clear? I have just reversed the depreciation charge by 6,000. Yeah, 10% depreciation charge of only 9 months. I have got the value as how much? 78,000, right? 72 plus 6, 78,000, right? 78,000. So after doing the depreciation charge reversal of that, what do you have? You have the book value on date of acquisition, which is 78,000, and let's say the market value is 1 lakh, right? So what has happened? 1 lakh minus 78, that is equal to 22,000 revaluation upwards, isn't it? Yes. So this is how you will do it. Just compare and you will get it. See here, revalue the asset and calculate revaluation gain or revaluation loss. You just have to compare. If market value of the asset on date of acquisition is more than the book value on the date of acquisition, you will have revaluation gain. what you will do of revaluation gain? It's very simple. Revaluation gain will be taken over here, pre-acquisition profits in the working note number 1, which is statement of net assets, or you can also call it as analysis of profits. You will just add it after the time adjustment. Remember this, after the time adjustment, okay? Right, you will just add it in the pre-acquisition profits, because you all know that the revaluation gain has been accrued in the pre-acquisition period. It happened before the date of acquisition. That's why it has to be added to pre-acquisition profits. Is that clear? Yes. And if the market value on the date of acquisition is less than the book value on the date of acquisition, then you have revaluation loss. You will just deduct it, opposite of that, in the pre-profits only, because it decreases your reserve, right? So you will subtract it over here after the time adjustment. Is that clear? That's what you need to do. And then what do you have? Yeah, so that's regarding revaluation gain and revaluation loss. And then what you have to do is you have to calculate additional depreciation or saving in depreciation, whatever you have in your question. So how will you get to know that? It's very simple. What you have to do is you have to just subtract two depreciations. What two depreciations? See, it's very simple. The first depreciation is the depreciation that should have been charged. This depreciation, okay, this depreciation on the market value, 9 months depreciation on the market value. See here, it's very simple. What did I say? Market value was 1 lakh, right? So 1 lakh into 10%, 0.10, that's equal to 10,000 into how many months? 9 by 12, right? 9 months. So 9 divided by 12, that's equal to 7,500. So 7,500 is the depreciation that should have been charged, because you all know, what do? Prospective depreciation is charged. When you revalue the asset, what does the AS10 says? You have to charge the depreciation on the revalued amount. Yeah, so that's why what you have to do, this depreciation should have been charged. Yeah, this depreciation, how much is that? 7,500. You just have to compare this, the depreciation that should have been charged, with the depreciation that already has been charged. What depreciation already has been charged? 6,000. The depreciation on the book value has already been charged, right, in the subsidiaries financial statement. So that you have to take. Okay, depreciation should have been charged is on market value, should have been. Already charged is book value, right? So this is the market value depreciation. Book value depreciation is, see, we already know 6,000. Yeah, 6,000. 9 month depreciation is 6,000. So just take that 6,000. So 7,500 minus 6,000, that's equal to 1,500 additional depreciation. We had revaluation gain, no? So additional depreciation. If you have revaluation gain, you will have additional depreciation. If you have revaluation loss, you will have savings in depreciation. Is that clear? Is that clear? Yes. And now this depreciation happened because of what? Revaluation on the date of acquisition. Because of revaluation gain, this, you know, this additional depreciation has been cost 1,500. It has happened after the date of acquisition, in the post acquisition period. This depreciation is of only post period of these 9 months. So that's why you have to charge this, where you have to take this, consider this in the post acquisition period, post profits. Okay, post profits. See here in profit and loss, post acquisition. Okay, you will take it over here after time adjustment. This is also after time adjustment. Everything is after time adjustment. Okay, in this case, if it is additional depreciation, then you will subtract it in the post acquisition profits, and if it is saving in depreciation, then you will add it in post acquisition profits. Okay, post acquisition profit. Is that clear? Yes. Then you have the last step, that is the balance sheet. This effect also needs to be given in the balance sheet. Okay, yes. So how will you give that? It's very simple. Consolidated balance sheet, just the asset value you have to take, right? So whatever the holding is there, just take that. That's irrelevant. Okay, this adjustment is irrelevant to the holdings value of assets, so just take that as it is. And then subsidiaries buildings market value you have to take. What's the market value? 1 lakh. Yeah, we compared it over here, right? So 1 lakh, that 1 lakh you have to take. Buildings market value 1 lakh minus depreciation should have been charged. Depreciation should have been charged. Where you will get this? Depreciation should have been charged. How much was that? 7,500. So 1 lakh minus 7,500, that is equal to 92,500. This is the value of the subsidiaries building in consolidated financial statement. In subsidiaries financial statement, there will be no effect. They will still show the building at the book value 72,000 only. Is that clear? This is only in the consolidated financial statement. Is that clear? So you understood how we have to do it. We just have to reverse the depreciation charge. Yeah. After reversing the depreciation charge, you will get the book value on the date of acquisition, market value on the date of acquisition. Just compare that, see whether you have revaluation gain or revaluation loss. Calculate additional depreciation or saving in depreciation. How will you do that? Depreciation should have been charged, that is on market value. Depreciation already charged, that is on the book value. Okay, and only of post period. Okay, only of post period. Don't take the entire period. No, only of the post period, because after the revaluation this thing is happening. Yeah, that's why, right? So if it is positive, additional depreciation; if it is negative, saving in depreciation, and this will be adjusted in post profit and loss. Okay, post acquisition profits, and this will be adjusted in pre-acquisition profit and loss, not profit and loss, sorry, pre-acquisition profits. Yeah, in the reserves. And the last step is what? You just take the market value of the asset and then just deduct depreciation should have been charged. See, it's very simple. You will not confuse over here. Should have been charged and already charged. See, it's very simple. Building market value you are taking, so depreciation should also be based on the market value. Then only your answer will be correct. Okay, building market value 1 lakh and market value depreciation. Depreciation should have been charged. That's the trick to remember. Okay, so this is what you will do, and you will get the value of subsidiaries asset in the consolidated balance sheet. Okay, so this was the whole adjustment. I think this has been simplified way better now. So I think you have got this easy, right? Okay, then see you in the next video.